Hello, everyone. Welcome to today's edition of The Final Bar here on Wednesday, December 11th. Today, we are on location this week in New York, and so we wanted to share with you some of the interviews we've done recently. This is actually going back to our conversations with people in Las Vegas a couple weeks ago, asking about their outlook for the rest of 2019 going into 2020. So today, it's a Market Outlook edition. This is The Final Bar. Good afternoon, everyone. Welcome again to today's edition of The Final Bar. My name is Dave Keller. I'm your host. I'm the Chief Market Strategist here at StockCharts.com. We're on location this week in New York and wanted to use this opportunity, being out of the office, to try a couple different things with the show. And one was to share some of the conversations we've had with our external experts, strategists, analysts, and money managers, people we've discussed and interviewed over the last month or two. And particularly today, we were wanting to focus on some of the conversations we had that really focused on a market outlook, to talk about the last 4 to 6 weeks of the equity markets in 2019, so really dealing with end of November into December, and then into the new year. And I've been asking most of our interviewees recently sort of what they think over that time frame. We thought it'd be kind of interesting to mash up some of the responses we got, because kind of interesting how it highlights people's different approaches, but also some of the similarities that we see. So I hope you'll enjoy today's show. We're going to start with a conversation with Jeff Hirsch. Jeff is the author and the editor of the Stock Traders Almanac. His father, Yale Hirsch, actually started a publication. It's something I've read for years, and really, really cool publication. Has some really good quotes every day. On the StockCharts.com store, you'll find a copy if you don't have it. But it does a really good job of focusing on seasonal tendencies, and that's where my conversation with Jeff really focused. Jeff, his work is based on seasonal trends. So the calendar, what tends to happen in certain months, what tends to happen on certain weeks, even certain days, but also things like the presidential cycle, the 10-year cycle, some of the larger cycles. And his focus relates to the seasonal tendencies within those larger cycles. And so in this conversation in particular, we were focusing on the challenges of defensive leadership over the course of the year, especially through the summer months. So, we had a market that's done very well in 2019, but for a lot of the year, defensive sectors like utilities and real estate did very well. Also, small cap versus large cap, is a lot of really interesting sort of patterns that have emerged. But in particular with Jeff, we focused on that seasonal trend. How do you think about, May through October being the seasonally worst, seasonally weakest part of the year, and then November through April being the seasonally strongest part of the year? We got to sit down with Jeff right as we switched from the weaker part, May through October, to the stronger part, November through April. And so it was really interesting to hear how he had pivoted from more defense to offense, and also pay attention to how he uses trend following, in particular the MACD, to qualify what he's seeing on those seasonal charts. So this is my conversation with Jeff Hirsch from the Stock Traders Almanac.
So here we are in early November. You sort of alluded to what's happening in the markets. The S&P continues to go to new highs. Things that had not really been working yet, like financials, now starting to break out and go higher. Defensive things like utilities and real estate that had been in a position of strength starting to roll over a little bit. What is your work? What is your process telling you about going into year end, heading into next year?
First of all, these things that just happened are so seasonal. It blows me away. I mean. Seasonals don't work perfectly every year. This year they're working like a champ.
It's great.
And a charm. And we got out of our utilities and defensives and bonds that we'd been getting into for April, May, June.
Right.
And then again, we got out of everything, or we had our sell signal for Dow and S&P May 1st, our seasonal sell signal using MACD.
Right.
And then July 19th was NASDAQ. So we were prepared for that. And we had our buy signal October 11th. So anything that was left over in the defensive baskets was moved out, and we went diamonds, spiders, cubes, IWMs, you know, the ETFs, as well as all the sectors, the financials, tech, biotech, all that stuff. We went in there. So to me, it was like teed up for us.
Yeah.
And that's part of what happens seasonally every year. These stocks, these sectors tend to come into the strength around October. If you look at the sector seasonality calendar in the book, there's this cluster in October where all these sectors, the ones you're talking about, some of the others, come into their bullish season.
Right. It's according to the playbook. That's great.
It is.
It's fantastic.
And it's set up technically, it's set up fundamentally.
So that was, again, just a snippet of my conversation with Jeff Hirsch. Jeff, you know, with the Stock Traders Almanac, also now managing money with the probabilities funds. And it's interesting, you know, it's funny, I've known Jeff for years and have talked to him a lot about just seasonal tendencies and trends. But it was interesting, this is the first time I've sat down with him since he started managing money using the platform. And for a lot of people, especially analysts and strategists, there's a huge gap between analyzing the markets and writing research, making recommendations, making commentary, and actually managing money. It's a very different skill set in a lot of ways. So it was really cool to hear how he has stayed true to his process, transitioning from being purely a commentator, an analyst, to more of a money manager, and really, you know, refreshing to know that he hadn't like completely abandoned what he was doing. It's, you know, he's proving now day to day that the seasonal tendencies are of value. So I thought that was a really cool conversation. More to that, and we'll share with you in the coming months. My second conversation was with Price Headley. I've known Price for a while. He's at a firm called Big Trends based out of the Midwest. He's out of Lexington, Kentucky. Super nice guy. And I asked him about, you know, the market outlook and just, you know, where we were at. And he talked about a little bit more about the corrective pattern, and essentially said with all the IPOs, with WeWork, with you know, all these you know, new companies that had come out and struggled so mightily, and a very different business model or lack of business model, with a lot of them inability to turn a profit being a challenge. He sort of talked about the internal correction, that, you know, the broad market was still strong, but there was an internal correction that was reflected most clearly with the IPOs that had come out and just not performed well from the beginning. So check out some of my conversation with Price Headley from Big Trends.
Yeah, we were saying in early October that you wanted to be ready to buy every dip because we're coming out of this 6-month sort of choppy phase and moving into the really positive seasonality November 1st through April 30th. So that, and you're seeing that the market is being very resilient. Even earlier today, Dow was down, managed to finish just back up ever so slightly, even though they were saying, oh, maybe the China thing was off, or the president said, and hadn't been fully authorized or approved yet after yesterday saying it was headed in the right direction. That kind of noise is the kind of thing you want to be ready to take advantage of. So I'm bullish because I think, in looking out not just on the seasonality, but on the fact that we've had the IPO correction of a lot of the unicorns and the money losers that have been either getting flushed out once they got public or being forced to go back to the sidelines like WeWork. That's actually good because the market is kind of correcting that little bit of excess that was happening in the IPO front. It's not like 99 and 2000 where everything under the sun's coming out with this big losses and just like, it's all about eyeballs, it's not about earnings. It's like, no, it really is about earnings. So it's really about, okay, can they, and even with WeWork, they're saying it has to be self-sustaining, so they're cutting everything back to get back to their true original core vision, just doing what they were supposed to do on the office space leasing. So, you know, it's like, okay, that's an internal correction that's happened. And a lot of people say, well, this market's too narrow, it's just being driven by the FANG stocks and the top big cap names. But there's plenty of opportunity within those names, and also what it leads to is that we can trade the downside on a lot of the other names that are underperforming. So I like that sort of bifurcation where everything's not going up or going down at the same time. I want to be able to trade some bull positions and some bear positions and benefit from that hedge, if you will, buying leaders and selling laggards.
So that was a bit of my conversation with Price Headley. Price, again, is you know, focuses on the options market, and I always love talking with people that look at a different market primarily than I do. I don't primarily look at the options market. I'm looking more at equities and ETFs. So I've always found it interesting to talk to an options trader or an FX trader because their perspective is going to be different. They have a different set of information that they're paying attention to. Someone looking at options pays way more attention to volatility, and I always find that to be an interesting conversation. So more to come from that. He talked a lot in our interview elsewhere about trading options, some of the challenges, some of the benefits of that, and I'll hope to surface some of that for you in the coming weeks and months as well. My next conversation was with Toni Hansen from ToniHansen.com. I love, and you'll see in the video, how Toni uses her body, uses her hands and arms to illustrate market patterns, and I thought it was clever and totally clicked with me in terms of how she illustrated it. She was probably the most constructive or most negative, most bearish out of all the conversations I had, although not climactically bearish, but talked a lot about corrective mode that we're in, a corrective mode. The NASDAQ overextended, at previous peaks, and how to think about that. So she was a little more cautious, and I thought that's a great comparison to some of the other conversations that were, very cyclically secular bulls and bullish conversations. So here's Toni Hansen from ToniHansen.com.
What I do at the beginning of the year, the first class or session I do at the beginning of the year is I'm like, what is our bigger time frame picture on things? Okay. And so like the way I timed the highs back in 2000 was that we had a lot of the tech IPOs, the internet bubble stocks, And so I saw a lot of those things doing the same pattern that the overall market was doing, but the overall market was doing it on a larger time frame.
Right.
So it was all of those rapid run-ups and then the crash. Yep. So when Bitcoin pivoted, I'm like, this is the NASDAQ 2000, go look, it's the same thing. Yeah. Sure enough, that's exactly what happened. And so when we're looking at like the much larger picture, like yearly time frame, I go and I take and I make inflation adjusted charts all the way back to the inception of the indices. Right. And I'm like, okay, now what do you guys see here? And it's like, wow, we've got like our 3 waves up, we've got some measured moves going on. Right. We're pretty extended. Sure. So you have to keep in mind, though, that is a huge frame of time. So, yes, this period of correction started within the last 2 years. Right. That's where we're starting to see more of that volatility. We're in a correction period. We're not still, you might technically still call it an upturn because we're hitting higher highs. Yeah. But the way the momentum has shifted, we're in a corrective mode right now.
Interesting. Okay.
So that's what I'm looking at too. Like on the weekly charts of the NASDAQ, we actually have a series where, here we go right here. Yeah. We've got our 2 highs, and then it had a little more of a correction. Yep. And now we're coming back up and doing a shelf and coming back up, and that is actually a reversal pattern there. Right. So we're actually coming into a reversal pattern on the weekly time frames on the NASDAQ here too.
Very interesting.
So that was a bit of my conversation with Toni Hansen. We talked about a lot of things. Toni's a great educator through her website, and so enjoyed talking about that side of it and how she's explored that part of her career. But this in particular, I thought with the market discussion was great. Again, she was more cautious, more corrective in her thinking than others, which I thought was a nice comparison. Let's completely switch gears now and go to Tom Lee. Tom is the chief strategist at Fundstrat based out of New York. And our conversation went a number of places. He is not a technical analyst. He is more of a strategist. So, uses charts as part of his process, but the core of his process, the bulk of his process is non-technical. But that was a really cool part of our conversation because we could explore some of the other themes out there. So he talks about the market structure from his perspective and really focuses on a cyclical bull market that we are in, that we are confirmed, his year-end target of 3,200 on the S&P 500, and what he sees going into to next year. In other parts of our conversation, we really got into cryptocurrencies, but this is focused more on a market outlook, and again, more from a macroeconomic strategy perspective. So here's a little bit of my conversation with Thomas Lee. He's from Fundstrat in New York.
Well, 2019's clearly been a very difficult year because if you were just following sort of headlines, then you were looking at tape bombs like trade war, impeachment, Brexit, inverted curves, record debt levels, but yet the market is on track for really its best year in over 22 years. Okay, so in a career you'll never see a market this good. And I think that the reason the market was defensive led was people were thinking this is late cycle, it's liquidity, and so they were buying defensives. But something's happened, and I think what's happened is, and we're seeing it, the PMIs have bottomed. So instead of us having an industrial recession that's tipping us into a global economic recession, It's really an inventory drawdown that's now starting to revive. You know, the ISM exports number went back above 50. We're talking the global economy is sort of kicking into high gear again. So it's a earnings recovery that the market's been discounting all year. This is an authentic breakout, and we think it's the start of a new cyclical bull market.
Fantastic. Do you have any projections or expectations about where we would see the S&P going into next year?
So some rough framework. So you know, by the end of this year, I think 3,200 is probably a reasonable target because we're hitting the Santa Claus rally.
Yeah.
But we did this study and we published it many times this year that the market's been nowhere for 20 months. So for 21 months, it's been stuck in a range. Since World War II, it's happened 3 times. 3 of the 3 times, these resolved with a massive upside breakout with an average gain of 50% over 2 years.
Right.
So this is telling us this upside breakout, S&P probably is 4,500. Now that sounds insane.
Right.
But keep in mind, if you look at S&P since 2017 to now, has only compounded at 7% a year. Earnings have compounded 11.
Right.
So the stock market has trailed earnings growth, actually. So I think 2019 is sort of a year of catching up to where earnings have grown.
So that was just a bit of my conversation with Tom Lee from Fundstrat, and I'm sure you could hear just in the way he answered my question, you know, very, you know, much less technical than the average guest that I've brought on the show, more thinking about the macro environment, thinking about valuations and the fundamentals and macro picture. I think it's really helpful. It's worth mentioning here. You know, we focus a lot on the charts because I feel like that is an area of your process that can always be upgraded. And I think it's an area that people under focus on, right? They sort of have some charts that they use and then they kind of move on and focus on other things. And I really want to dig into the technical themes. However, they are not in a vacuum. And even though we focus just on the charts, I think a thoughtful investor combines the technical with the fundamental, with the macroeconomic, with all those different potential catalysts for stock price movement. So I thought it would be helpful to incorporate a conversation with Thomas Lee into the show today, just to remind everyone the value of thinking about some of the themes he talked about, valuations and macro drivers. And again, as a thoughtful investor, think about how what he said relates to the charts, relates to what we're seeing with the long-term trends. Having said that, my next conversation was with Brian Shannon from Alpha Trends. Brian's a really good, really thoughtful guy and really well-spoken. And we talked a lot about his work, which focuses on multiple time frames. He wrote a really cool book on multiple time frame analysis, which was well done. We talked in particular this time about bottom-up investing, and all the conversations up until now, for the most part, have been top-down things, thinking about big picture, the S&P, commodities, interest rates, etc. What my conversation with Brian went to the bottom-up process and how stock picking, how screening and looking at individual stocks and individual themes, how they relate to the big picture is really important. So I thought it was a really cool conversation to wrap up today's show with. So this is my conversation with Brian Shannon from Alpha Trends.
The semis continue to lead at an unbelievable pace. I mean, they just keep seeming like they're up too much and they're ready to roll over and die, and then they go again.
And then they keep going.
Right? So I become cautious on those, but I don't want to get bullish. Not when we have a bigger backdrop of, you know, rising 10, 20, 50, 100, 200-day moving average. They're all rising. I'm not going to fight those. There's nothing in particular that, I mean, IPOs are heating up again. And I think that, you know, I honestly don't know the name of it. It's PGNY. This stock came public, I think, at 13, ran to 15, pulled back a little bit, broke above its VWAP, and we bought it at $17.40 earlier this week. Just sold some today at $20.40, so $3. And, you know, it hit a measured move as well. So I think the IPOs are going to start to get a little more interesting once again. It's good to see that the institutions aren't buying the garbage and allowing that crap to keep coming at these crazy levels, which I want to talk to you about from a Fidelity perspective off camera.
Off camera, we'll do that. Okay, fair enough.
So again, it's not what I tend to do is when I look at a lot of stocks, my process is to look at a lot of stocks you know, on multiple time frames each day. And I start to notice as I write down notes, hey, there's another semiconductor, there's another healthcare, there's another healthcare. So I don't go from the health, like you said, Fidelity would go bottoms up. And I didn't actually realize that. I thought it was a top-down shop. So it's great to hear. you get a head start, I think, on the top-down people.
Yes.
Because you see it bubbling under the surface, and by the time that sector or the ETF starts moving, you're already in one or two of those leaders who are making that move. By the time the whole weighted index catches up and drag the bottom feeders as well, we're already looking at going, well, that's of course,
obviously, That's great, guys. And it's funny, I always tell our viewers, it's so easy to get the blinders on, think of the big picture, think about stocks, bonds as an asset class, where there's so much message at that bottom level, looking at the stock level. So
if you're managing 100 million, 100 billion, whatever, if you're managing big money like that, you have to go top down.
Of course.
And it sounds so smart when people say all this stuff that no one understands. So I'm, deep down, I'm just a stock picker. And I'm proud of that. It's not just a stock picker.
That's great.
So that was some of my conversation with Brian Shannon from Alpha Trends. We talked a lot about screening, about bottom-up processes, and again, the big difference is the top-down, thinking of the big picture, the macro charts, macro drivers. The opposite of that is more of a bottom-up process, looking at individual stocks, screening for ideas, looking at individual charts, and then connecting what we're seeing on the individual charts to the big picture. And I think that's a really important part of the picture for a lot of investors that they miss. They tend to focus on one or the other. You are screening for ideas, you're a stock picker, and you just focus on the individual charts, or you're a top-down investor thinking about the broad market, looking at sectors, ETFs, and sort of living there, and you don't really meaningfully connect the two. And I think it's a really cool process, really cool idea to look at the broad market charts. A lot of the charts that I show you on the show, sort of my chart lists, my candle glance pages, looking at all those big picture items. But I also do a lot of screening, looking at the scooter rankings, using the scanning engine, just going through a lot of individual charts, using the chart list and just looking at the patterns that emerge. And if you do those both, you will find a lot of times, like what Brian said, a lot of the themes will become more obvious, I found, from the individual stock level. You will notice all the financial stocks doing a certain thing, or healthcare, all of a sudden the individual names start to look more attractive, and there's signal there that can help illuminate what you're seeing with the broad market charts. So I hope that was a nice way to wrap up the show for you in terms of thinking about bottom-up screening. So today was all about sort of connecting the dots, these conversations with each of these strategists. And again, those were just 2 or so 3-minute snippets from a lot of really cool longer conversations. We're excited to bring you more and more of those conversations in the coming weeks and the coming months to unpack some of their expertise and get in front of you. But for now, we are going to transition to one of my favorite segments, the 3 in 3. So the 3 in 3, as we all know, 3 charts in 3 minutes. If you've not looked at these charts in a while, I hope they are on your radar as of this moment. So recording this a little earlier in the day on Wednesday, so these aren't totally updated, but I think I'm focusing on some of the trends that I hope you should be focused on. Number 1 is Dow theory. So this is the traditional look at the Dow Industrial Average and the Dow Transports. Again, a real traditional look at different parts of the economic environment, seeing if there's agreement between producers of goods and the distributors of goods, the industrials versus the transports. What's interesting, and the whole idea to this chart is whether you get confirmation or non-confirmation between the two. So are they confirming each other's trends, or are they not confirming? And what we have right now is what I would consider a non-confirmation. So you have Dow Industrials recently going to new highs, but most recently actually a bit of a lower peak. We'll have to see if that actually is confirmed, if that actually is a valid peak if we continue lower, but overall certainly not going up anymore. But look at how transports have completely rolled over. So there's a real non-confirmation with industrials holding above support, transports breaking down through support. And transports now includes a lot of things: airlines, shipping companies, railroads, all of those are sort of included. But again, that divergence or really that non-confirmation is one theme that I'm certainly paying attention to going into year end. Theme number 2, or chart number 2, is the GSCI commodity ETF. So there are a number of ways to look at the commodity complex in general, things like the CRB index, the Bloomberg Commodity Index. Here I'm looking at the Goldman Sachs Commodity Index. And what's interesting is I think this is very sneakily testing potentially new highs here for the last couple months. There's this big spike back in September, which lines up with resistance back in July. We're not there yet, but we are testing resistance from the last month, from the last 4 or 5 weeks. So this peak around 1580 is pretty key, and we're just testing that point. And I would say, commodities now have broken above trendline resistance. They've now broken above moving average resistance, and the very last piece would be breaking above price resistance. And if that happens, don't look now, but commodities are actually in a bullish trend, which would be very different of an environment that a lot of us are used to. So I think that's an interesting thing to watch. But then finally, the relative performance of semiconductors. If I had one chart just making me feel calm and comfortable with the market strength or cautious and nervous, it would be the relative performance of semiconductors. And the fact that overall semiconductors are holding up fine, this ratio is holding its 50-day moving average just fine, tells me overall until that changes, the market's okay. And all these other themes are just sort of tactical themes around that trend. But again, higher highs, higher lows, market strength means the market's in an uptrend. Innocent until proven guilty with the bullish argument there. That's our 3 and 3. And ladies and gentlemen, that is our show for today, for Wednesday, December 11th. I want to thank you all so much for tuning into the Final Bar today and every day. You can get any questions to us, the Final Bar at StockCharts.com. We'll be doing a mailbag session later this week, and would love to incorporate your questions. So please keep them coming. Also on Twitter at Final Bar SCTV, and check out our YouTube channel for StockCharts.com. Lots of really good content on there. For StockCharts.com in New York, I'm Dave Keller. Have a great night.
Indicator settings. What is the perfect setting? Well, actually, there's no such thing as the perfect indicator or the perfect settings. You have to really adjust the indicators for what you're trying to look for. Take RSI, for example. I use RSI to find short-term oversold situations when the bigger trend is up. And to do that, you kind of have to tailor your RSI. So if you look at this example, we've got IJR with 14-period RSI. That's the default setting. And if you look here, well, from February on, it didn't become oversold once. So if you're looking for an oversold opportunity to partake in the bigger uptrend, you have to adjust your settings. And I prefer to use 5-period RSI. And if you look at this chart, you can see a number of oversold readings, and that gives you a mean reversion setup. In other words, you have this trend, and you're looking for a pullback and a bounce that mean reverts. Now, that's for major index ETFs like SPY, QQQ, IJR. When it comes to individual stocks, I typically use 10-day RSI because individual stocks are a little bit more volatile. And so on this example, you can see I've got ICE becoming oversold there in early August and bouncing, and you got a little breakout and a move to new highs. So the bottom line is, there's no perfect setting, but you got to think, what am I trying to capture, and use RSI to capture that.
I'm going to talk about how to use the volume by price option on StockCharts. It's an overlay, not an indicator. And what we do is we put it right in the back behind the price. So in order to do that, we're going to go in under the overlay section. We're going to select volume by price, and it defaults to 10 bars. But if you'd like a little finer control of that, you can set the number of bars there by just putting in a number, and usually an odd number is better. But what happens is when you select that, it will draw out the bars, and you can see that clearly this current bar is one of the highest levels resistance or support. So this is a very interesting place for the price. Anyway, so remember, when you're using volume by price, it's an overlay, and you can select how many different bars you want to see on the left-hand side, all the way up to 100.